Hi, I'm Larry Gaines. I've been a professional trader for over 40 years, trading options for over 30. Now, one of the most often asked questions I get is how do you trade market volatility successfully? And what I've learned based on my trading journey is that my best, most profitable trades, no matter what trade environment I'm in, all had a certain specific reoccurring characteristics. So I define these winning trade characteristics and I'm going to share them with you today. So the secret to trading profits comes down to direction, timing, and then solid risk management, and that's using options for all your trades taken. So I put together a 7-step process to help find better and more selective trades. So first step is, what is the market cycle? Are we in an uptrend, downtrend, sideways, or extended? Now, 2 is you want to quantify the market condition you're currently trading in. So you want to quantify the degree of uncertainty. Is it high, low, or extreme? And then quantify a stock or security's relative strength. 4, select the chart pattern. I have 5 selective chart patterns that I look for, and one specifically which we'll cover in this presentation. 5, we want to look at the time horizon. So how long do you think the trade will take to work out? So that's duration of the trade. And then we want to look at what option strategy to use based on the market environment and conditions we're trading. And then 7, timing is critical. So trade execution, when to get in, when to exit, and then your risk management. So step 1 through 5, we want to identify market cycle, market condition, and then we want to validate your stock's relative strength or time horizon to the stock that you're trading. So is the market or stock you're currently trading, is it in an uptrend or downtrend or sideways or extended? So we want to identify and quantify what that trend is. So to help me do that, I use 4 primary moving averages to identify track trend and to find areas of support and resistance. So the 4 period moving averages are the 8 period exponential moving average, which is a fast moving average. Then I use a 21 exponential moving average, and then a 50 simple moving average in the 200 period. So on all my charts from a daily all the way up weekly or monthly, I'll always have these 4 moving averages to help me kind of track trend and identify key areas of support resistance. So here's a current example. This is the S&P 500, SPX. So as I'm doing the presentation, this is kind of currently where we are. So this is a weekly, which I can call a long-term chart. And then the one here, this is a daily, medium term. So you can see in the weekly time frame, we've been in this really sustained, very strong uptrend. And we're now just starting to test it a little bit to the first 8 exponential moving average. So that's the first area of support. Now, if that breaks, we still have good support. We could go all the way down here to 43.12, and that's the 21 exponential moving average. So that's the big mean reversion there. So you can see that's the big area of support. And then here's the daily. So we had a cycle reversal here with my indicators. Okay, that purple arrow, so down here. And then we're getting momentum pushing down. So my momentum indicators are going negative on the daily. So the market's losing momentum to the upside, and now it's starting to lose buying exhaustion. And you can see we're getting a break towards the downside. Now the first key area on the daily will be this 50 simple moving average, 44.34, which that aligns right about in here with that 8 exponential right in here. So that's the first key area of support. And this is what we look for, as far as tracking trend and look at these different support resistance levels. So next you want to quantify kind of the market condition, degree of uncertainty. Now there's always going to be some uncertainty with the markets, but you want to try to quantify it. So, is it high? So, are we at extreme highs or lows in the market? So high uncertainty could be coming from the FOMC meeting or some important economic news, non-farm payroll. Or are the market conditions very extreme inflation, extreme, kind of some kind of market crisis, war, pandemic. So kind of quantify the degree of uncertainty, and then that's going to dictate then how to trade the market. So next we want to measure the relative strength or weakness of a specific stock. And we can do this using relative strength indicators and momentum indicators. So trading in any type of market environment is all about, again, price direction, timing, and then managing your risk. And the best trading signal for signaling price direction and market timing is going to be based on relative strength and price momentum flows. Now, relative strength measures a security's strength or weakness versus its industry or another security within its industry sector. And then momentum measures the speed or velocity of a price change and is measured by continually taking price differences for a fixed time interval. Now, momentum indicators then will signal this price strength or weakness, And when measured across multiple time frames, this creates a dynamic trend following indicator that's going to help you to identify new price trends changes early, going to help to validate a trend strength or weakness, and then this will help you stay within a trend to maximize your profit based on that momentum strength or weakness. So here's an example of Apple. So Apple right here, this is a daily time frame, and you can see that the momentum indicators here, so this is a zero line. So this is a histogram, so when it's below zero, that's negative momentum. So my cycle 1 indicator here is a really fast momentum indicator. 2 is a slower indicator that I use to confirm. But you can see the momentum here started fading right there, and you can see momentum started going down right here. So see the histogram then start really tailing off, and you can see how that momentum really escalated and price really started dropping hard. So that's a current example of price momentum and using 2 different types of measurements. Now another good measurement to use is relative strength. So this is an example of Apple versus S&P 500 SPY. So you can see this is a line chart. So you can see here that this is a weekly time frame. So you can see where Apple, the momentum started shifting up, and you can see how the cycle of this trend, this spread between Apple and SPY started moving higher. Now it peaked out right here. You can see at that point there, Apple was basically 136 dollars per share above SPY. And then you can see the relative strength started coming off right here. And so you can see that it rolled over. So you can see that Apple now is currently underperforming SPY, and it's starting to kind of have that mean reversion back to where it should be around that 21. Now it's also exceeded that, so it could have more of a sell-off, more momentum to the downside. These are really helpful to know what the relative strength is to a specific stock, to another stock within its sector, or into the sector itself. Now the next step in my selection process is to identify certain winning chart patterns. So I've got 5 specific chart patterns that I look for, and the one that's the most common that I look for is what we call the volatility squeeze. So let's go through these patterns. So the main pattern I'm looking for is what I call the volatility compression squeeze. So this pattern can be actually within these other 4 patterns that I've identified. So one is what we call a cycle high reversal, the cycle low reversal, cycle low retracement reversal, and a cycle high retracement reversal. So basically a cycle high reversal would be, your market's trending up and then you get buying exhaustion, it turns over. Cycle low reversal is where you get to the bottom of the market, below the moving average, it starts turning over. And retracements are where your market price goes into certain key moving averages and then has either a cycle low retracement failure, or a high retracement failure into a certain specific moving average. But the pattern that I'm looking for within these is what we call this volatility squeeze compression pattern, which offers a very strong breakout pattern to play. So the volatility compression squeeze pattern is identified as a period of price consolidation where price is kind of coiling in a tight pattern and then has an explosive momentum breakout either up or down. So when a security then has multiple time frames in a volatility squeeze, the breakouts are generally even more powerful with greater follow through, like a chain reaction explosion. I kind of call it like lightning in a bottle. Now the chain reaction is then set off by a lower time frame volatility squeeze, could be a 30-minute, 60-minute, and then that triggers in, it ignites the next higher time frame, and it creates a powerful price movement either up or down from these squeezes triggering. So it becomes a really fantastic setup for swing trades, day trades, and gives you that big timing edge. So remember, time equals risk. So the quicker you're in and out of a trade, the less risk you're going to have. So here you can see the squeeze. So I've got my indicators have these dots that indicate when a squeeze starts. But the thing you can see is it's in a coiling tight pattern here. So it's just coiling. Now the next question is it going to break up or is it going to break down? So I'll use trend lines or prior breaks of prior highs or lows. But then we want to know what's the potential direction. And so we're going to use our momentum indicators to give us probable direction either up or down for the breakout. So here's a really good example with Netflix. This is the daily time frame. Now with this you can see here's the squeeze. So you can see all the dots. So I've got the green dots indicate that the momentum is to the upside, and if you see purple or magenta, it means to the downside. But what we're looking at is our squeeze. So it's identified this pattern. I've got it coded into the indicators. And then we're looking for a probable direction for the breakout. So that's where momentum comes in. So you can see my cycle 1 lower momentum and 2 momentum are up. The trigger breaks to the upside out of the squeeze. So here's another squeeze. You can see the dots right there. See how tight that is? And then momentum again. Cycle 1 and 2 are up. Breaks out of the squeeze. Here's another squeeze right here. Which direction does it break out? To the upside. Cycle 1 and 2 are up. So, markets tend to stair step up, and this is a really great way to identify these consolidation patterns and identify the breakout direction. And I'll always use multiple time frames. So I like the combination of a 4-hour with the daily. So this is an example. This was overstock. So you can see here, it had a really tight, nice compression squeeze going on the 4-hour, which triggered first, and then that triggered the daily right here. See that compression squeeze, momentum all pointing up, so potential direction was to the upside. Next, we want to look at the trade execution, option strategy to use, and risk management. So what I've found is that my winning trades, my best trades, all had a timing edge, and that was really important for trade execution. So by incorporating multiple time frames, or what we call fractal analysis in your trading, is going to give you better clarity to an overall trend. So first off, the longer time frame allows you to see the big picture in order to get an idea of the general trend. So I typically use the daily time frame for the big picture general trend. Now then we want to use the shorter time frames or your lower time frames. They should support and be aligned with that general trend or the anchor trend to show trend strength or weakness, and then used for plotting the actual trade entry into your general trend or what I call the anchor trend. So you're never going to get the whole picture of trend by just using one time frame. So here's an example of Apple. This is a weekly, which I call long-term, and a daily. So you can see the weekly trend is currently turned over, but we're into this key support right here. That's the 21 exponential moving average, but momentum is starting to shift down. So Apple is, in a critical state here as far as momentum, and you can see the daily trend is shifted down in negative momentum. So Apple potentially has more downside to it based on the lack of buying momentum and turning into selling momentum. So the next thing you want to do is you want to look to your support resistance levels, which will be Fibonacci levels, and then moving averages. So currently here on the daily, that's the 100-day moving average. The next big moving average would be here, the 150 coming in about 166. And then the really big one is the 200 right here at 160. Now the next step is very important as well. So this is selecting the perfect option strategy. So that's what I call the option strategy confusion. So there's so many different option strategies out there. So a lot of times you have an idea of maybe what to use, but you're not certain. So you have debit spreads, you've got credit spreads, you've got diagonals, etc. So what you want to be able to do is to identify what option strategy to use based on the market condition you're trading. So let's take a look. So it comes down to the option strategy to use and then when to use it. So the strategies I like to use are option spreads. So I like to use long calls or puts, and I like to use those typically with a vertical debit spread or maybe a vertical credit spread, butterflies, long condors, income calendars, and counter diagonals. So these are the main option strategies that I'm going to use and incorporate to trade whatever market environment we're in. Now here's an example I'm going to show you. This was on the company Square. So we started this trade out as what we call a long call calendar diagonal, and then converted it into a butterfly for zero risk. So I'm always telling my clients and members to always think 2 or 3 steps ahead when you're trading to see if you can plan out a trade where you can enhance the value of the trade either by lowering your risk or lowering your theta. So this trade, just to kind of go through it quickly, this started out as a counter diagonal. Then we adjusted the trade to where we ended up with a butterfly. So we ended up with a long call butterfly and had no risk in the trade. We covered all of our costs by adjusting the spread. So we ended up with a 71, 75, 79 butterfly. So let's go through. So Square had this really nice volatility squeeze here. So we set this up as a counter diagonal first. And then when we had the breakout, we adjusted it right in here to a butterfly looking for a potential pin in around what we call an expiration pin at around $76. So when we set the trade up originally, the calendar diagonal, it was trading at 67.60, and then we adjusted it to call butterfly free trade, no risk in the trade, when it was trading at 70.84, and then took profit when it was at 76. So here's the trade setup. So here are the legs below. So on the 12th, we adjusted it to the free trade when it was trading at 70.84. So here's where it went out, on the 21st. At that point, it was trading at 76.09, and this trade was up $293 on zero risk. So we had the trade originally. We had the long call, the 71 at $99. Then we sold a 75 call against it, brought in 62. Then we sold a credit spread, making this the butterfly at 42. So net we had a credit of $5. So if it went outside the wings to the upside or downside, we would have still made $5, but it actually went out with a profit of $288 plus the credit of $5, so $293 per butterfly spread. Now, I hope this trade presentation was beneficial to you, and if you'd like to learn more about me, the trading program, and courses I offer, then here's what you can do next. So using the link provided on this recording, you can come down here and use the link provided on the recording. Click here and you're going to get a 30-day free trial membership to my trading club. So here's a Power Stock and Trading Club. So basically you're going to get interactive trading room with me every day during the week. You're going to get live Q&A for the full month. We do those once a week, the recorded and live. And then members trading archives, trading educational vault, and you're going to get 60% discounts off of all my courses and trading software. So if you come down here and subscribe, you're going to get this for 30 days at no cost. If you want to renew, then I've got a number of different plans that you can take advantage of. So I hope this helped. Good luck trading, and thank you very much for watching this presentation.